All
your
right,
research.
we're about to go.
We're good. Yep, we're good.
All right, we're live. So you all might be with us via any platform, might be on the internet. You might be listening to our podcast right now. It is Wednesday, June 17th, and we're going to be talking to you all again about understanding what it means to blindly follow a guru in any industry. Particularly today, we're talking about the stock market. You know, as IEA has grown, the Investing Education Academy has been terrific, but what happens when you blindly follow a guru? Be it Leon, be it myself, be it some of the names we're going to name today. Leon's going to give you the details. I'm going to do a little housekeeping. If you have questions, please post it, and we'll get to it. If you're listening to the podcast later on, there's a link to actually send us an email. You can send us an email from the podcast, and we will answer it the best we can.
Yeah, so today, like Brent said, we're going to cover, so the reason we're covering this is because, and again, the topic is why you should never blindly follow anybody. Always do your own research. One of the ones we get in our Facebook group a lot is Warren Buffett, right? So Warren Buffett today is going to be our example. We're in no way, shape, or form bashing Warren Buffett. Warren Buffett is the man. He's one of the best investors of all time. But just going to show, since everyone kind of likes to reference him as kind of the guru of choice, just going to show that, that he's, he's not a god. He's not end all be all. He does make mistakes, and he's not always right. And so just give you some little background on Buffett. The reason why he's one of the best investors of all time is because over the last 55 years, so since 1965, so his returns are tracked by his stock. His stock is Berkshire Hathaway. The stock symbol for that is BRK, either /B or .B. So it's BRK, either /B or .B, depending on your platform. That's a symbol for Berkshire Hathaway. And that's how you kind of track Warren Buffett's success or failures. So since 1965, over the past 55 years, he's returned on average every year 20.5%. Now remember, the market in general, which is tracked by the S&P 500, returns on average 10%. And when you include dividends, it returns on average 12%. So Warren Buffett is effectively has doubled the market over the past 55 years. That's incredible. It's one of the best returns in modern history of investing. So 20.5% over the last 55 years. Now, that's great. That's wonderful. And Warren Buffett, like I said, Warren Buffett is the man. And Brent, could you throw up slide one?
Yep.
And just another thing about Warren Buffett. So his company, Berkshire Hathaway, it owns some of the big names that we know, like Geico, Fruit of the Loom, and Dairy Queen. So he owns a lot of big companies that aren't public, but all his assets are tracked via his stock, which again is BRK.B or BRK/B.
Real quick, so you all know when Warren Buffett got started in the industry, one of his strategies was buying companies that still had cash positions available, or the stock was trading lower than their cash position. And he did it where he can also accrue more shares than the majority shareholders. And he would do it through, sometimes directly, he would buy out or buy into a company. Other times, he would just buy shares from stockholders. So he's a very savvy investor. And he would invest until he got to the point where he was the majority shareholder, effectively owning the company. And so when you think about strategy and stock, it's not always just ownership to have appreciation of the stock or ownership to get the dividend payout. Sometimes you want to have access and control of a company, and people will acquire your company or a company through acquisition of stock. And sometimes it's done in an unfriendly environment. Sometimes it's understood. But Warren Buffett, just so you all know, he's not just a person who has meandered his way through the investment world, getting great returns. It was a very serious strategy behind how he built Berkshire Hathaway, which now effectively has changed the way stocks split. So Berkshire Hathaway has had a huge effect on the market and how companies behave when it comes to their stock.
Yep, and like Brett said, I mean, Warren Buffett is the man. He's actually helped change and shape the way stock splits happen, and things like that. So Warren Buffett is the man. This is no way bashing Warren Buffett. We're just using him as kind of a proxy for any guru or any investor that you follow. We're going to show why you don't want to follow people explicitly and blindly without doing any sort of research. So what this chart up here is showing you, so in our Facebook group, a lot of people know that, and follow the lines. A lot of people know that Brent and I have been investing in the airline industry of late, because it's, as we all know, it's dropped about 60% the industry as a whole because of COVID. Now, what this chart is showing, I didn't want to use any particular company like Delta or American, because they kind of have their own individual issues. So I use this ETF called JETS, JETS, and it tracks the aviation industry, airlines locally, airlines in the U.S. and some airlines abroad. So give you a really
quick, Lee, let me jump in.
Mm-hmm.
ETFs, for those of you all who don't know, before we go too far into it, is an electronically traded fund. ETFs are accounting for one of the biggest exodus of mutual funds, traditional mutual funds, into these electronically traded funds. They normally trade similar to stocks, but they're invested, like Leon said, they're tracking an industry. Now, he's about to tell you about this particular JETS ETF, but we just wanted to make sure you understood what an ETF was. And if you don't, please post it in our Investing Education Academy group if you want to start the discussion on ETFs. And for those of you all who are wondering, inside of our membership platform, we're actually going to have an area specifically geared towards educating people on ETFs.
Yep. So, okay, so anybody want to look this up? The stock symbol or ticker symbol is JETS, JETS. Okay, so what I'm showing you here is and for people that don't know, so it was a really big deal at the end of May, end of April, beginning of May. Warren Buffett came out and said that Berkshire Hathaway had sold its entire position in the airline industry. And Warren Buffett, and anybody doesn't know, Warren Buffett, so when Warren Buffett invests in a company via the stock market, a lot of times he'll buy companies outright. But when he invests in a company via stock, he essentially owns the stock for life. Like, I mean, I know that sounds ridiculous, but his holding period is literally 20, 30, 40, 50 years that he'll hold a stock. Warren Buffett is generally, I mean, he even said the other day when this happened, he made the point that when they liquidated the airline industry stock, they sold all of it. Like, he said the reason we did that, because he said we don't trim positions. We either buy, the stock, or we sell the stock. There is no like buying and then selling 20, 30, 40%. He sells it all. So just know that Buffett typically when he buys for essentially ever, 30, 40, 50 years to hold it. So okay, what this is showing, so this is going to be our analogy for the airline industry using JETS. So what you see at the far left, so Warren Buffett started buying the airline industry around 2015, right? So the far left you see where it says Buffett buy in that box. That's right around the time Warren Buffett started investing in like American Airlines, Delta, Southwest, the industry at large. So that was his first buy, and that was roughly, I think, about $26. His second buy was right before the COVID crash, which was roughly $32, right? And then of course we had the COVID crash, right? Everything tanked. So right around, so you see the bottom there where it says Buffett sold. So he bought back in 2015 around 26. He bought earlier this year around 32, and then essentially lost it all when it tanked and stock dropped to around, I can't see that right here. What is that? What was that bottom, Brent? Is it
It's about 11.25.
So about 11, right? So okay, so the bottom fell out, right? So at that time, right around the time, so Buffett sold right around May. So Buffett sold right around $14 in JETS. So now think about it. If you were in the stock with Buffett from 2015 and earlier this year, the drop. So once you did that first buy in 2015 to when it bottomed, we'll just say at about 14 when he sold. That's about a 46% drop. From when he bought in 32 at about 32 early this year to 14, that was about a 50% drop, right? So Buffett lost. So when Buffett sold, the position at the time was worth $4 billion. I don't personally know how much he lost on this trade, on this investment, but it was a lot of money. If when he got out, it was $4 billion, and he lost 46 on one trade and 50 on another trade, he lost tens of billions of dollars on this investment, right? And so again, he sold the bottom right around the beginning of May at right about $14 here in JET. So for me, I was totally surprised when I heard this, right? It actually made my ears perk up. And when I heard this, I started to do a little research myself and wondering, okay, what's going on with the airline industry at this time deeply. And I did my research, and that's when I found out the two major things that I knew were going to happen, because it happened before in all crises. The government was going to bail the airline industry out. But I wanted to kind of see, okay, what were the terms of it? I looked at it deeper, and I'd written about this before, but the bailout was going to be via loans, right? So the airlines, if they needed, they could take these huge loans from the government. Crazy part is those loans weren't necessarily going to be paid back, but they're going to be converted to stock. So the U.S. government was now going to directly own U.S. airline companies via their stock. So the U.S. government now has a stake in these airlines. The U.S. government can print money at will, right? So right now they had these loans that were available to them, but say those loans were exhausted. Is the U.S. government now going to let their newly acquired asset fail? Of course not. That's why they gave them the bailout in the first place. And now that they're a stakeholder in these companies, they can now print as much money as need be if that first bailout doesn't work. So when I did my research, I realized, okay, one, they've been bailed out, and two, they have access to unlimited cash. Okay, but forget all that now, right? Let's think about. I then say, okay, let me take a step back and say, okay, what effect does the airline industry have on the U.S. economy? When I did my research, I found out the aviation industry is 5% of U.S. GDP. Okay, U.S. GDP is $21 trillion a year. So that means that the airline industry contributes $1 trillion to the U.S. economy roughly per year. So Warren Buffett got out of a position that represents 5% of the U.S. economy. Now, again, he sold all of his position, not just some, all of it, liquidated the whole thing. So somebody typically only does that, they think, one, there's no growth in the industry at all ever again, or two, it's going to zero. And like as I just said, the federal government is now backing the airline industry full-throated, right? Because they're essentially going to own big chunks of the industry. So it was really, really, really puzzling to me. Why did Warren Buffett sell, $4 billion worth of stock in the airline industry, the industry that contributes 5% GDP to the U.S. economy, worth $1 trillion, right? So I did all my research, and that's what I found out. But one of the things I heard when I kind of did my research was interesting. So he said this. He said, and this is a quote: I don't know that 3 to 4 years from now, people will fly as many passenger miles as they did last year, right? So what Buffett said, now remember what I said earlier, Buffett's investment time frame is typically 30, 40, 50 years. His quote was, I don't know if basically what he was saying is, I don't know if the airline industry is going to be where it was last year in 3 to 4 years. Now, for Buffett, that's almost like day trading, right? Because remember, he holds for 30, 40, 50 years. For him to say, yeah.
In that space, it's been speculated that, Buffett may be taking his position because he's not going to be in the game that much longer. And people are saying, I don't think it's true. It's just rumored in the industry that he's kind of, this isn't an insult to anybody who's aging, but he's been making bad decisions in his elderly years. So it's unfortunate, but even some of the gurus, I mean, you're looking at Carl Icahn, and I think it was Brandon Erwick, they've been talking about, essentially, these are fund managers, right? And if anybody knows fund managers, that's institutional money. And when you look at institutional money, these are people moving billions or hundreds of millions of dollars on a monthly basis. So it's now being said that, maybe he's aligning it not with his investment strategy before, but with his time frame to stay on with Berkshire Hathaway, like in a forward-facing authoritative position. So it's speculated. But also, for anybody listening, when Leon made that mention to the fact that the federal government is now basically becoming shareholders in the market, it is arguable that the stock market is one of the safest investments that you can make. And before, everybody really looked at munis or municipal bonds, double each, H. They looked at those bonds as being like the most secure things you can buy. But what's happening is, as industries scale up, the U.S. economy is recognizing, or our government, really, is call it what it is, our government is recognizing they can get more money in the stock market than they would issuing bonds. And because of that, they want to get in. Right now is that point where it's starting to become public knowledge that this is happening. Before, it was a lot of complicated deals and nobody really knew who held what. So you didn't know where the support was coming from. But if you were listening to Leon and I a few months back or a few weeks back, we talked about the fact that when these natural disasters hit, and there are triggers in the market to shut down the market. And so, you have 20% move, the market's going to shut down. And it actually works on the percentage move based on the number of days of congruent downflows in the market. And so all these safeguards in place, I hate to say it, is not so much to protect us, it's to protect the US economy. And is not to protect the US economy just to protect the US economy. The government wants to make sure they always have money. And so I think it's arguable to say that stocks are fast becoming one of the safest places you can put money. Now, of course, you can argue when we talked about life insurance and we talked about real estate. It's an argument for all, but the whole point of Investing Education Academy is to start the discussion. So as Leon goes through the rest of this chart, just kind of think about who's really being protected. And if they are protecting their position, why wouldn't you put yourself in place to benefit from that? And you can't say you didn't know because we're telling you right here.
Right. And yeah, and that's a good point, is that the US government may or is now, depending on these loans and what companies took and what companies didn't, but maybe one of the largest shareholders in the airline industry. And again, it's like if you start a business and your business gets in trouble, you're going to do everything you can to save that business, right? You're going to, exhaust all your savings, do what you have to do to save your mom and pop business. Same with the federal government. They're not going to let an industry now, one, they're now a stakeholder in, and two, that contributes 5% or $1 trillion to the US economy. They're not going to let that fail, right? And so it was just crazy to me that Warren Buffett, the man, the myth, the legend, would liquidate a position in an industry that he and everything I just told you is not new information. It's not hidden. This is all public information. And that's another thing I want to make a point. People like Buffett, people think that they have some sort of like magic wand. They yield some sort of power over the market. They don't. They have all the information they have. We have too. Now, the one thing they do have.
Well, Leon, I wouldn't say that.
Public information.
They have friends with high level clearances. They get information that a lot of us can't get. Let's be clear.
Well, but I would say, if they trade off that, it's insider trading. So you're right. There are instances where, as we all know in this world, the more you know, the more people you know, the more money you make, the more resources you have. Agreed. But what I'm saying is generally based on the information that's traded off of, for the most part, it's all public information. Earnings, sales, product launches, things of that nature are public to the market. Now, what's going to happen in the future as far as maybe a buyout, that's all not supposed to be known to the whole public knows. So I'm going off the adage, I'm going off the assumption that all public information related to stocks is known, right? So everything I just told you about the government bailout, them owning stock, stuff like that was all known. Everything that he knew, we could have known. At least that's public. So that's what really blew my mind. Like, knowing if he knew all that, why did he get out of his position? A lot of people were like, well, he must know something that we don't know, right? So a lot of people actually followed him and sold their positions. Now, going back to the chart, you see Buffett, we're going to effectively say Buffett sold out on this chart at $14, right? Because he bought it. Remember back in the day, he bought it 26, he bought it again at 32, and then he sold out at 14. So you're looking at a 46% loss in the first buy, about a 50% loss in the second buy when he sold around 14. Now, since then, what happened, right? Since then, and this was only a month later, the market recovered 57%. I mean, on that first buy he did at about $26, at the high of that bounce, it was almost back to even. So whomever bought them would have been almost back to where they were. They wouldn't have taken that loss had they stayed in. Now, since then, the market has pulled back some, and the position is up 28% from the low. So what's my point? My point is, did Buffett know the market was going to shoot up like this? Of course not. Did he think it was going to drop? He may have, but did he know? Of course not. My point is, had you blindly just followed Buffett into this trade and or investment and got out at which essentially right now is the bottom. It may not be the bottom for the future, but all we know right now it's been the bottom over the past month, and he sold right near the bottom. Had you done that, you would have taken a massive loss, huge loss, right? Had you stayed in, had you done your research, either bought and or stayed in, you'd have recovered a whole lot of your losses. So again, blindly following Buffett, you would have taken a massive loss. Doing some of your own research. Now I'm telling you what I did. When I heard about this, I went, dug up, did my research and found out about a lot of stuff. So for me, I'll just tell you my position. I bought Delta the first time at about $42, right? Delta then went from $42 down to I think the bottom around 18. So I took a 50% loss on that position. No big deal, because again, my positions are sized right where no one position can blow up my account. And I go into things, especially during the COVID, I knew we were kind of going through some turmoil, so I expected some losses. But what I did when I heard about this whole Buffett thing, I actually bought more, because it kind of woke me up and said, okay, maybe pay more attention to the airline industry. So I went ahead and did my research about what was going on with the buyout, and I bought more. I think about 20. And I believe Delta right now is, I don't know, somewhere in the mid 20s. So my break even right now is about 28, 30 bucks. So I'm a little off from break even. So that's what I did. So again, for me, it's a long-term position, 3, 5, maybe 10 years. But for Buffett,
real quick, so for when Leon and I had this conversation about the airline industry, it might have been March sometime. I knew with the bailout was one thing, right? The bailout was one thing. But for me, when I saw what was happening across the board, it made it, and this also includes cruise lines. It made it seem as if no one ever was going to do anything recreational that included travel. Right. And that's just asinine. If you look at what was trending, I went back and I did a much more simple approach. It was just how much were people flying before, and was that trend line going up or was it going down? And ahead of COVID, it was on a continuous rise on the amount of people who were using airlines to fly, which led me to believe that it's going to go, even if with the 80% drop, or in some of the companies, or let's say 50% drop on average. Only thing you really need them to do is do 25% more than what the drop, get a 25% higher than the drop, and you were going to profit if you got it somewhere in that March timeframe. That's just the way I looked at it. I was like, people are going to fly again. Even if they don't, it's worth the risk, because when the government bails them out, then they just need time at that point. And time in the market is what really heals. I mean, that's when you win, is when you give yourself or give the market time to correct itself, right? Additionally, the airline is one of the biggest employers in the United States. So that to me told me that they're going to have to get corrected to get these people employed again. I mean, because you got to think that's going to kill TSA. It's going to kill all the janitorial services, the airline companies that maintain the airlines,
suppliers, part suppliers,
everything that goes into the airline industry. And it's what Leon oftentimes we say is too big to fail, right? And that was my thought, So for some of you all thinking, well, I didn't know how to do all this research, or I wouldn't know how to pull up a graph like this. What makes sense? What about, and for you all who are listening to the podcast, JETS is the ETF for the airline industry, and is ticker symbol JETS. And the graph shows that it's been a bumpy ride, right? And even with JETS, if you were to buy it today, I personally think it's still a good buy. And so, what do you believe is going to happen in the airline industry? You can look it up. You can spend some time researching, and you can also just spend time thinking, like, will people fly again? And do you believe they'll do it at scale? I do.
Right, exactly. And so far, I mean, nobody knows the future, right? We have no idea what's going to happen. But as Brent said, just common sense tells you that, and we all know everyone. I mean, it's being shown now with the openings in the U.S., right? People have flooded bars, clubs, restaurants because they're tired of being held up. I just heard a report yesterday that airline ridership is up, I mean, hugely from last month. I want to say something like almost doubled. Now, again, coming from a low base because airline traffic dropped by 95%. But as states have opened up, airline traffic has come back, slowly, but it's slowly coming back. And we're also seeing higher infections now in these states that have opened, because everyone was so tired of being pent up that they just been running out to do anything, have dinner, go to a club, sit outside, whatever. So that pent up demand was just, I mean, we all felt it. Like Brent said, it just made sense that that airlines were eventually going to come back. So back to the chart. So from the bottom, we now see that it bounced at 57%, and right now it's up 28%. So and as I said, all this was done with basic research, right? All this stuff is stuff I just Googled, right? None of this is rocket science. I didn't jump down all these different. I mean, it did take some time, of course, but all this is out there and can be done by anybody. It's nothing that heavy of a lift. So to wrap this portion up, Warren Buffett got into airline industry about 2015. He recently sold out his entire position. His first buy was down about 46%. Second buy was down about 50%. If you blindly followed him into this trade, you lost a ton of money blindly. Had you done a little research and kind of see how the bailout was going to work, kind of use a little common sense, you would have been fine. You would either bought in at the lows, or you would have stayed in knowing that eventually this thing is going to come back, which it will, because again, we're talking about 5% of the GDP of the US GDP at $1 trillion. It's backstopped by the federal government. They're not going to let it fail. So why Buffett decided to do it, only he can answer that question. And I think to Brent's point, it's also true that he's 80 something, late 80s, I believe.
Yeah.
He's not going to be in the game much longer. But again, and that also comes back to another point, is that when these gurus make these investments, we don't always know what their motive is. Right? We don't know. We don't know why they're. I mean, so big firms like Warren Buffett they have to report what they buy and sell, right? But a lot of times you don't exactly know why they're doing it, right? So he'd have to say he's buying jets or he's buying Delta or whatever because he has so much money, but you don't exactly know why. It could be a hedge. It could be to cover some losses. It could be tax selling. We don't know. Buffett for some reason saw selling here, his whole position made sense for him, right? It may not make sense for you. Right, that's why you get your situation is not Warren Buffett's. Warren Buffett has, as I said to Brent the other day, and Buffett has almost more money than God. Right, none of us are in that position. And for us, as we try to tell people, you want to hold on to your positions for at least 3, 5, 10 years. Buffett typically holds on for 10, 20, 30. But for some reason, on this particular trade, he was looking at it really short term, 3 to 4 years. For him, like I said, related to us, is almost like day trading because he holds for decades at a time. So his motives changed, and but we didn't know that when he sold, right? He didn't come out and say. Go ahead, Brent.
And so also one of the things when you really get it, like when you get what Leon is saying, it all boils down to regardless of who the guru is, and there are gurus in every industry, regardless. And I'm saying Leon and I also are saying this. We're going to be quite transparent as Investing Education Academy grows. Some people have been turning to us like, we're just going to do whatever you all do. And although that is extremely flattering, the reality is you still need to do your research. And as the next chart, I think the next chart is going to go into some more information about this. But just remember, whoever you're following, number one, does it just make sense? Let's start there. Does it just make sense what you're hearing? If it doesn't make sense and you're trying to stretch, you normally know it. You know if you're just doing it because they're doing it, or if you are like, you know what, that makes some sense. In all situations, we suggest you do research.
Right.
And you know what? You can actually call the company, and most companies have an investor relationships number, and you can ask why. A lot of people don't know that, but most large companies have an investors relations department. And you can actually call and ask them questions. That's what they're paid to do. They're paid to be ready when the phone call comes in and answer questions to the best and most honest way they can. So, utilize your resources. And again, if you're listening to us, we're telling you the tools are out there. Even if you don't want to do it yourself, there are ways to just get other people to do it for you. Just be responsible for what you do.
Right. Exactly.
You want me to go to the next one?
Yeah. So go to the next one. So that was one example, right? Where if you had followed Buffett blindly, you would have gotten hurt. You would have lost money. So I'm going to give another one real quick, and then I'll get to this chart. But so another instance recently where Buffett kind of tripped up was, so back in 2015, he bought Heinz. So we all know, a lot of us know Heinz as the company that makes ketchup. It's probably the most famous one. He bought Heinz. He then merged Heinz with Kraft Foods, which created a company called Kraft Heinz. The ticker symbol for that is KHC for Kraft Heinz. That happened back in 2015. Since then, Kraft Heinz is down 60%. 60%. It's been cut in half since Buffett made this massive move to buy out Heinz and merge it with Kraft. So again, Buffett being the great guru that he is, had you followed him and bought Kraft Heinz back in 2015, you'd have lost 60% of your money. Again, not knocking Buffett, but had you blindly done it, you would have lost a lot of money on that. So some people may say, okay, well, you're cherry picking Buffett's losses. Everyone has them. He's still one of the greatest investors of all time. I 100% agree. But as Brent said earlier, he's not the investor he was 20 years ago. And this chart will show you a little bit why. So this chart is from the beginning of this year through, I think, June, this month. So the blue line is his company, Berkshire, and the red line or orange line is the S&P 500, right? So you see, beginning of the year, Berkshire was underperforming the market or the S&P 500, right? And then the COVID drop came, everything tanked. Everybody lost, every stock lost then. But look at it since the bounce, right? So we bounced. I think it bounced in March.
Yeah.
And look where look at it now. Berkshire is still down. So at the lows, both of them were down about 30%, right? Berkshire is still down 20%, where the S&P 500 is only down about 5%, right? And so Berkshire is greatly underperforming the market. And the reason being is for things I just said, the issues like with the airlines and the issue with Kraft Heinz, how terrible that deal has been. So this is only over 1 year. So
and Leon, real quick, so for anybody who's wondering, like, what does that mean? Like down, well, Berkshire Hathaway for one share is $275,000.
Well,
that's roughly the price of some people's houses.
That's the A share. Remember the B share is like $180 or something.
Yeah, well, I'm talking. Yeah, so this is the Class A share.
Yeah, right.
This is the share when normally when you're talking about Berkshire Hathaway, most people are going to defer to, because this is when he started to create a new ecosystem or a new tradition in non-splitting stocks, right? When you have that kind of money, like, I don't know what the total fund. Do you know what the total Berkshire Hathaway fund is worth?
No, because remember he buys companies out directly and then also has stock in companies.
Yeah.
So no, I don't know what it's worth total.
Okay, but just so you all know, because right now the chart we're looking at is Class A, and right. So we're talking about a stock again that's $275,000. For those of you all who are listening to the podcast and you're like, what is like 20% down from what? Just so you know.
But Brent, I will say that the Class B tracks roughly the same. So Class B will about down about 20% also. But yeah, this one is the really expensive stock. But the B share is the one that the average person like us would buy. Will track roughly the same.
Who said I can't buy the A share?
I mean, hey, you got 230 grand for one share?
275,000.
Yeah, right. Yeah, it's unbelievable. But okay, so yeah, so with this now, so as I said, not cherry picking, because what I'm showing you here is from the beginning of the year to now, Berkshire is well underperforming the market. Beginning of the year was underperforming. Now it's still underperforming by an even bigger amount, where the market is down about 5%, where Berkshire Hathaway is down 20%. So some people might be saying, okay, well, it's only 6 months, no big deal. Well, Brent, you can pull up the third chart, please.
All right, and while I'm pulling up this third chart, somebody made a comment like, can you really call an investor relations department at a company? Not only can you do it, one of the things that personally I did when I was in college, I was a banking and finance major at Bowie State University. And when I had complicated homework, I would actually call mutual fund companies, 1-800 numbers. I would call stocks investor relations line. And I told them the problem that I had in class and asked them if they could help me walk through it. And they would do it. I'll tell them I was a student. I didn't know how to solve the problem. And I was wondering if somebody there could help me. And they would walk me through these problems all the time. It's not about, can you figure it all out? And I say that for a purpose. It's not about, can you figure it all out on your own? Are you savvy enough to figure out who can solve the problem for you? And in some of the space, I know you all are joining IEA's ecosystem because the Facebook group has grown. I mean, it's over 200 plus referrals or some ridiculous amount of number in the last 3 months, right? Because you all have trusted me and Leon and I to bring this information to you all. People have asked us about the podcast because they want to travel with it. They want to listen to it at home. The information's out there for you all in other places besides just here. And one of our goals is to show you where to go to get the information so you can have research like this. So you can we'll start talking to you about it. So this type of conversation isn't foreign to you. And, just call it what it is. A lot of, minorities, they really don't have these conversations over dinner. And when you get into, again, white America is not trying to, bring that back like full force, but the reality is they do talk about some of the stuff over dinner. And so Leon and I are trying to bring you what is the equivalent to our Wednesday night dinner talk. So,
right.
we're gonna go through this last chart, but kind of just think about all this as we go through it. There are ways for you to acquire this information, and IEA is one of those sources available to you all now.
Mm-hmm. Yep, and like Brent said, the investor relations at companies, that's their job. Their job is to engage with investors and disseminate information that's requested. So, okay, so the last chart was only showing 6 months and showed that Berkshire Hathaway or Warren Buffett underperformed. Well, like I said, some people may say, okay, that's only 6 months, no big deal. Well, this is 10 years. This is a decade worth of data, right? From 2010 to 2020. So the bottom one, I'm a little colorblind, but the bottom one I believe is orange at the far right.
You're completely colorblind.
Colors hurt my eyes. I think the bottom one is orange, the middle one is blue, and the top one is
red.
Blue. Yes. Yeah. So the bottom one at 241%, the middle one at 242%. Those are Warren Buffett's two companies, the A and the B shares, right? So let's just say Berkshire Hathaway over the last 10 years has returned 242%, right? The red one above that is the S&P 500. S&P 500 has returned 254%. So what does that mean? That means Warren Buffett has underperformed the market by 12%, right? Put that in numbers terms, on $100,000, that's $12,000 that you would not have made if you just blindly followed Warren Buffett and didn't invest in, say, an index fund for the S&P 500. Now, of course, as we always tell everybody, you can do both. You can buy Warren Buffett's fund as well as its S&P 500 and get double that return. But the example I'm making here is that if you had blindly done no research and said, okay, if Warren Buffett is buying, I'm buying, you'd have underperformed the market by 12%. You'd have left, relative to $100,000, you'd have left $12,000 on the table just because you didn't want to do any research, you didn't want to look anything up, and you just blindly followed Warren Buffett. So again, the point we're making here is any guru that you follow, be it Buffett or any other hedge fund manager, or not saying we're gurus, but if you follow anything that Brent and I say or do, always do your own research. Google is your friend. All this information we presented today was found online. Research I did here was online. So none of this is hidden. None of this is any way special. It's just a matter of taking the time to go and do it. So the point we're making here, if you followed Warren Buffett blindly over the last 10 years, you would have underperformed the market by 12%. You could have went and just bought the S&P 500 and beat Warren Buffett by that 12%. Again, on $100,000, you would have made an extra $12,000 buying the S&P 500 versus just blindly following Warren Buffett. So main point is do your own research.
Yeah, and in this space, everybody, I'm just putting a chart up so you can actually see the number. If you could take some time again, just it says $275,000 for a share. He clearly has been successful in his career. This is an individual that has built a company. And I remember when, again, we're gonna go back to when Leon and I set up in Wealth Enterprise, which was our investment club in 1997. Berkshire and Hathaway, one of our members, chose to take the profits they made in Qualcomm and they moved their money into Berkshire Hathaway. I believe at the time it was $10,000 a share. Mm-hmm. And I remember thinking like, oh my gosh, this person's about to put, I never thought they were crazy, but I thought, oh my gosh, they're about to put $10,000 into this share.
One share.
And they were buying two. And so This goes back to when you all hear Leon and I talk about companies that have, in some people's minds, an expensive price point, right? It's only expensive relative to what you don't know about the future. So if we would have told you in 97 that this share is going to be worth $275,000, you probably would have thought it was the cheapest thing in the world. Mm-hmm. But the market is forward looking, and as an investor, you also have to be. There's no, like Leon said earlier, there's no crystal ball on, what's going to be successful, what isn't. However, if you would have had that money in a bank account in 1997, it still would not have doubled.
No, that's close.
It still would not have doubled. You're still looking at about 20 to 37 more years before that money doubled. Mm-hmm. Doubled. If you would have had that money in Berkshire Hathaway, that $10,000 would now be worth $275,000. Imagine cashing two $10,000 investments, right, and going to buy a $500,000 house and having money left over to build a pool. This is what we're talking about when we say it's very important to look at where you're putting your money. And again, I want to say that because I want it to sink in. Imagine taking a $20,000 investment and now pulling it out, a $20,000 investment, and going and buying a $500,000 house. And we're only talking about what, 20 years later? Mm-hmm. A $500,000 house and having money left over to build a pool. It's just, these are the reasons we have to put our money in better places. Mm-hmm. We absolutely have to put our money in better places. And all of us are employers, and our employees are our money. Every single person, when anyone receiving a paycheck, disability, unemployment, whatever, if anyone receiving a check for anything, you are instantly an employer. How will you put your employees to work? And that's all it boils down to. So I'm gonna stop the screen share for a second, Lee. It's been asked, like, why Leon and I do this. Is it to really become a voice of the people? Is it to, make as much money as possible, becoming gurus ourselves? No, it's so we can have a business that is growing, this providing information that normally people would not receive so they can have a better life. And because it is a business for us, we do have a membership platform. We will be doing private events that, have a fee associated to it so people can grow and make more money. But if you look at what's happening inside of our ecosystem, people are making money. Like, we're not sitting out laid across Lamborghini hoods, and this is Leon's pet peeve, but you all are going to see him. And right now what's happening is, last 2 weeks, Leon and I did a 2-part series on the wealth gap that exists within America, right? Between white America and Black America. And I feel like it was the closest feeling I've ever had to being a journalist who cracked the story. Leon found the topic and he was like, "Hey, Brent, I think we should talk about this." I had trepidation at first. I was like, "Oh, it's real sensitive right now," but it needs to be told. The story needs to be told. So Leon, I'm in. I'm gonna follow you with that. And when he started telling me what it was about, the information, it was so jarring that I was like, I became excited. Like, no, we have to, like, I was all in plus, like, let me go grab some slides myself. Now we're seeing you all have been great. You all have been sending us like new information to talk on related to it. And, we wish we could talk about every topic we're receiving, but as we get bigger, just too many, we're getting a lot of requests. I'll put it that way. But in the same token, we're starting to see all these news media outlets talk about it. We're starting to see organizations talk about it. And the reason I'm saying this is you're about to see a lot of false prophets. The market is about to get flooded with false prophets. If they don't have a track record in investing, if they don't have experience actually being in the market, if they bought one stock, they got them a 200% rate of return, and they're on the hood of whatever, like, I got a 200 rate of return on this. Leon and I can pull one out of my portfolio right now, this 474% rate of return. You know what? I'll tell you what it is. It's Netflix. Like, anybody can pull one stock that's been doing incredibly well. Just be careful. And again, we don't care if you join the IA membership or another one. We want people in the market. But we want you to be the same way we say don't blindly follow a guru. Don't blindly follow the person with the fancy car or, the woman with a bunch of guys around her saying this is how much I make. Just be careful. It's about to be a lot of false prophets in the marketplace trying to take advantage of people, desperation to, fight unemployment, to fight this inflation that's happening. To kind of get to a place where they don't have to experience this again with the same type of anxiety. Be careful while you're out there. And I had to say that.
And to that point, it kind of goes back to the chart I had a bit of Jets, the ETF. So as I showed, the market Jets is up 57% off the lows around where Warren Buffett sold. That's not normal, right? Stocks don't move 57% in a month typically. I mean, the market we're in right now, as Brent said, there'll be a lot of false prophets because a lot of people right now are making a lot of money really quickly. This is not normal. As we said over and over again, the market on average returns 10% per year. For an individual stock, you can look anywhere from 20 to 40% per year. Jets alone has returned 57%, almost 60% in a month. So just know that, right, the market that we're in right now, this COVID market, this jobless market, like the market is just crazy right now. But the returns you're seeing right now are not normal. Be prepared. Once all this is over, we're going to get back to the 10% on average for the S&P 500. We're going to get back to 10% to maybe 40% for individual stocks. Of course, there would be more, but I'm just saying kind of on average. So, I mean, as Brent said, both of us right now, I mean, some of in the group, some of the picks we've made are up 60, 70, 80%, right? Great. We're happy about that, but we know that's not normal. Like we picked those because we knew they were tremendously undervalued assets that are going to have a serious bounce once all this kind of comes to an end. But going forward, we're not expecting 60, 70, 80% on our picks, let's say a year from now or 2 years from now. We're not expecting that. We know that's not going to be the case. Or that potentially won't be the case. But yeah, just know that right now, as Brent said, a lot of false prophets, a lot of people saying that they know what they're doing because they got 20% in a month or 60% in a month based on Jets. It's not normal. But it's a great time to be in the market because we can take advantage of these bounces in these stocks.
Yeah, and as you all know, we promised you all 2 picks every week. And I see someone asked us to discuss, it's Beverly, Attorney Beverly Winstead. Now, I do have to say, Beverly, happy birthday to you.
Yes, happy birthday, Beverly. Yeah. Yes.
For anybody listening, Attorney Beverly Winstead's birthday is today, and she's one of our faithful IEA members. And
Hey, yo, Brent, real quick. Bev tried to bribe me earlier into giving her the picks early because it's her birthday. I was like, nah. You gotta wait. You gotta wait till
What did she offer you?
Well, she would just say because it's her birthday.
Oh, the birthday. She played the birthday card.
Yeah, I was like, nah.
Okay. So, I mean, anybody knows Beverly. She was named one of the top 40 attorneys in the nation in 2018. Top 40 attorneys under 40 in 2018. She's like the first person of color to serve as the IRS National Board. I'm gonna say it wrong. Division of Taxation with the IRS. She's a record breaker. I mean, she's actually somebody we're probably gonna read about in history books. And today's her birthday, and she's with IEA, so we're happy to have her. We want to say happy birthday. Yes. And she requested that we talk about Black Wall Street was Tulsa, Oklahoma. We can't go into that right now, but what I will say is the reality of Black Wall Street is it's actually the name is misleading. It leads you to believe that it was a Wall Street in Tulsa, Oklahoma, but in reality, it was a thriving entrepreneurial African-American entrepreneurial community. And it was entrepreneurial based, not stock based. And it was burned down because of the success. And it was mass murders that happened just to eliminate this African-American community from prospering. It's a horrible story. But, we can't go into it in full depth, but I did want to say, some people hear the term Black Wall Street and they think it was related to the market, and it wasn't. If anything, it was most closely related to oil, but that's a whole nother thing. Beverly wants happy birthday, and we will talk about it in the group. So like, if we want to start that conversation, anybody who wants to have it with us, come over to Investing Education Academy on Facebook. We can keep wishing Beverly a happy birthday, and we can talk about, what Black Wall Street really was. And the picks for today is the drum roll. Leon, I'm gonna pull yours up, but I'll go first so that way I can just eliminate mine once it's up. So give me 1 second and pull mine up. It's Berkshire Hathaway. That is not my pick. So for anybody,
like you're doing a lot.
Yeah, I'm not claiming that. So I am choosing Apple today. Apple is trading at $351 a share. Again, for anybody, it is Wednesday, June the 17th. My stock pick is Apple. Ticker symbol is AAPL. Again, public service announcement. Please, everyone who watches this or listens to us who's not familiar with the market, when you go to buy companies like Apple or any other company that we name, be sure to check the ticker symbol when you buy it. This goes into really what Leon and I were talking about today, blindly following gurus.
Right.
Even we've had people who have, unintentionally blindly followed us and bought stocks that we've suggested and they end up getting the ADR or, you know, some other like even when we talked about Berkshire Hathaway, you can get class A or B, but if you're not paying attention, you may just go look it up and go 275,000. No way. And you would have, if you would have looked up the B share, you would have realized it's about $200. So ticker symbols are very important. I'm choosing Apple today. The ticker symbol is AAPL. It's trading at $351 a share. Not going into after hours trading or anything like that. Most of us know Apple, so I don't have to give an introduction. The reason why I love Apple right now is the fact that we're heading into a space that's going to be full of promise in regards to the technology sector, and especially when you start looking at wireless. Apple is poised to take extreme advantage of it. And when we move into AI and robotics, Apple is also going to have a leg up over a lot of its competition. And AI and robotics is here. It just hasn't become mainstream yet, but it's not coming. It's not soon to be. It's here. So as 5G continues its methodical like spread across the U.S., which I'm still not a fan of, but it is a reality. Apple is going to benefit hugely from it, and I think we're going to see a boom in the stock price. So for that reason, I am choosing Apple, and I'm seeing Apple really being a play where between like 2 years is when you're going to start to see like a really serious move in it, and from there on, I think it's going to have a jump and then kind of level off.
And on Apple, the point Brent just made about 5G is really big because they're calling that what could be what's known as a super cycle. And what that is where basically there's this massive, I'm going to say it's like over 50% supposedly or potentially that upgrade their phones that are already out there. So a potential huge, massive super cycle and upgrades for Apple phones are coming once they launch their 5G, which was supposed to be this year, but because of COVID, I think they're pushing off to next year. So yeah, as Brent said, getting in ahead of the whole 5G move, you know, could be a really big profit for the future. So my pick is Cisco, ticker symbol CSCO. Today it closed at $46.17. It was down just a little under 1%. So a lot of you all have heard me talk before, and Brent's pick was the same thing, but I pick based on sectors, right? I pick the sectors that are leading the market higher. Technology is the number one sector leading the market higher over the last 5 to 10 years. So that's the main reason I picked Cisco. Cisco is one of the largest networking companies in the United States. So the tech industry was up 30% over the last year, whereas the S&P 500 is up only 5%. So that shows how the outperformance of tech over the general market has been. Again, tech 30%, S&P 500 5%. Huge difference there. Some information on Cisco. So their 2-year profit growth, the last 2 years has averaged about 13.6%. And their sales have averaged about 2.1% over the last 2 years. One of the key parts I love about Cisco is that they pay a 3.1% dividend. And remember, again, you get that whether the stock goes up, down, or sideways, whatever the stock does, if you buy the stock now, you're going to get paid 3.1% on the money that you invest in the stock, regardless of what it does. So if Cisco goes up 10%,
Leon,
go ahead.
For as long as the dividend is staying at 3.12, dividends do move, but they stay somewhere close. So for as long as it's 3.12, that's what you oversee.
Right. Yeah. If they raise a dividend, of course, it'll increase. If they lower it, it'll decrease. But yeah, as Brent said, as long as it stays at the dollar amount they're paying per year, you get your 3.1%. And the point I want to make about dividends again is that they pad gains and they cushion losses. So if say Cisco went up 10% this year, you'd actually make 13% because you get that 3% dividend. And say Cisco was down 5%, you'd actually only be down 2% because you still get that 3% dividend. So dividends are a really, really powerful way to kind of, again, pad gains or cushion losses. So Cisco is my pick this week.
And to touch on Cisco and really the dividend, many people have asked us in the group, and I hope you guys are participating in the conversation inside of Investing Education Academy on Facebook. Find the group, join the group. Some great conversations. One of the things that came up is dividends. When you get the dividend, do you get a check mail to you? Do you get it put in your account and just let it sit inside the whatever sweep account, money market that you may have in your brokerage account? Or do you reinvest it? And for that answer, I'm going to give you the traditional consultant answer. it depends. So it's a conversation I think we should have deeper, but just so you all know, with your dividend, you can do what's called a dividend reinvestment plan. It's called a DRIP. And so many stocks that offer dividends have DRIP plans available. DRIP plans means they're going to take whatever the 3.12% equals over the course of a quarter, and they're going to use it to buy fractional shares of that stock. So like DRIPs are the original fractional share. And so depending on what you want to do, if you are an investor similar to Leon and I, and we have different styles of investing when, in our moods or certain categories of money. So we're not always long-term, but for the most part, if you have a dividend reinvestment plan set up, you're probably a long-term investor. What happens when you do that in a very abbreviated version is that dividend then buys fractional shares of the stock. Now the original portion that you purchased plus this dividend are accruing more interest. So when your dividend comes out the next time, you're getting dividends on the dividends, and the primary purchase asset that you acquire is called the underlying that you acquire, which is that stock. So now you get this next dividend check that buys more fractional shares. So you have the original asset or the underlying, the dividend hit, and the dividend hit accruing more interest. So your dividends tend to get bigger, normally get bigger over time, and your stock becomes, you have a greater share of ownership in the company because your dividends have increased. Again, is way more to that than that brief synopsis. Leon, did I miss anything in regards to just saying that quickly?
No, I mean, one way to think about it, also like almost like compound interest. So like Brent said, it's gonna. So if you get your dividend for however much money, it's gonna buy whatever percentage of one share it can buy based on the amount paid. So yeah, you'll buy the share here, you buy fractional shares here, then your next dividend is then gonna buy another set of fractional shares, and it just kind of compounds itself. So over time, it's kind of like compound interest that over the years it adds up and adds up and adds up, and then you'll see you start out one year with maybe 20 shares. Just from a DRIP plan, you may end up in 5 years with 50 shares. And say you didn't put any more money into the stock, it's just that your dividends were reinvested and you're adding more shares passively over time. So yeah, DRIPs are really powerful. For me personally, I don't participate in DRIPs. The reason being is I like to invest the money myself. I may not want to buy. So for instance, Cisco pays a 3.1% dividend. Let's say in the first quarter of the year, they're gonna pay me my dividend. I just let it hit my account. And then what I'll do is I'll go in there and say, okay, do I want to buy more Cisco now? Or maybe I want to buy Microsoft, or maybe I want to buy Amazon, or maybe, what have you. So that's because I'm more active in the market. For people that are not as active and that are, not as in tune to the market as I am, a DRIP makes sense. But for me, I like to kind of control where my dividends are invested. And it may not be the stock that a dividend came from.
Yeah. And for me, I always do the DRIP plan, because I'm just like, you know what? I bought it for a reason. I just want to let it grow as much as possible. But sometimes I don't want to use my own money to let it grow. So I'll set up a DRIP knowing I'm not going to, or I have no intentions anytime soon to put new money into it myself, but I'm still kind of creating a dollar cost averaging system through the DRIP. So everything about investing comes back to like what your style and strategy is. And it is what's right for you, because somebody else may say, you know what? Not only am I going to get the DRIP, I want the money to hit my account, but I'm going to use it for gas. And so, your whole point is I need to get an asset in place that just allows me to get a big enough DRIP to cover groceries for, every month. And so now you're using your asset to now start acquiring just household needs of yours. So you always protect your primary investment. It's a lot of strategies to what you can do with it. And, too many to go into this conversation. But again, these are the conversations Leon and I love. So
right, all day long.
Yeah, we probably keep going forever. So
right.
Want to carry the conversation.
Last point on the dividend. So in the group, we were talking dividends in the Facebook group, and I let everybody know that I just made a purchase of Norwegian Cruise Lines with 100% dividend payments. So I didn't touch any of my actual money in my account. I just took the dividends, and I think dividends totaled like $100. So I took that $100 and bought more of Norwegian Cruise Lines. I think I got it for like $15 or something. But again, I didn't touch any of my own money, took all that dividend money, and then bought a few shares of Norwegian Cruise Lines. So that's an example of, and those dividend payments came from Microsoft, Visa, and I think ConocoPhillips. But it was from 3 different companies over the last, I think, 3 to 6 months. And I took that money and from those 3 different companies, and I bought Norwegian Cruise Lines. And again, that's an example of me not reinvesting in those companies because I just don't, at the time, I didn't want to put that money back in. But we all saw recently that Norwegian dropped a bit from its recent run up. So again, I just dropped, got some more shares, about $13. But again, not with any of my own money, but money that came from my dividend payments, and essentially got quote unquote free shares, not free from not free as in I didn't pay for them, but I didn't use any of my own money. I used money from my dividend payments.
Thank you for that.
Yep.
Yeah. My brow went up. My brow went up. I was like,
yeah, you saw it, right? I caught it. Clarification.
I mean, with that being said, again, we want to wish Attorney Beverly Winstead a very happy birthday. And she's my tax advisor. So I definitely want to keep her happy because with all this stock and stuff we're doing, we need somebody that understands the taxes of it. And she's going to be we're going to bring her into the IAA ecosystem to talk to many of you all about, what happens on the tax side of all of this trading. So just, look forward, but no, we have a very strategic plan on how we're going to grow and how we're utilizing the assets inside of the IAA ecosystem to bring the best information possible. So anybody listening to the podcast, thank you so much for listening to our podcast. For those of you all who are trying to figure out how to keep the conversation going, you can come over to Investing Education Academy on Facebook's platform. And very soon, Leon and I will be announcing what we've been working on, like the big, oh my gosh, like you guys did all this and it's a lot. It's a lot that we have cooking. And we think that you all are going to be extremely pleased. We are. I mean, honestly, I think if we just use everything we did, we're going to be happy.
Right.
So we have a huge announcement. It's going to probably happen July the 1st or somewhere the first Wednesday after July the 1st. We will announce it and we will be opening some doors to you all, giving you new opportunities to kind of go deeper with us. So it's going to be fun.
So, right. So just last point,
yep.
This whole live was about don't blindly follow anybody when it comes to investing in the stock market. Always do your own research. If you want to see examples, go back and listen or watch this live or this podcast to see some examples of Warren Buffett, one of the greatest investors of all time, while following him the last 10 years blindly, would have actually lost you money relative to just investing in the S&P 500. So always do your own research.
Yep. And for those of you all who asked us for some of the tickers inside of the group or on this, we will supply the tickers in the comment section. And again, if you're looking for the ticker symbol for Norwegian Cruise Line, Leon, I know you probably know it offhand.
Yeah, it's NCLH.
NCLH. The only reason I don't want to type it is because I don't want people to confuse that with our pick who may be watching this later on. So NCLH is the ticker symbol. Still confirm it, even though we're saying it. Still confirm it.
Right, go type it in. Yep.
Yeah, don't blindly follow gurus. So.
And we're not. And by the way, we're not gurus.
Yeah, we're not self-proclaiming. We're just saying we do know some people put us into a category. You all know more than us, and we're saying back to them, you know what? We know it because we researched it. You can research it.
Right.
That's all really gurus are. I mean, they just had a lot of time in the market and they've done a lot of research.
That's it. Right. So anybody can do. So.
Yep. So all right, everybody, it's been a pleasure. Thank you for tuning in. We will be back next Wednesday, right at that 9 o'clock time frame. And if you are looking for us, you can find our channel on YouTube. And if you are interested in joining the group again, go to Investing Education Academy on Facebook, and you can look us up. And all of our podcast people, thank you for listening. Have a good one.